Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, guys, well, the very busy earnings season continues. The SPY roughly flat on the day, the Q's down, and that was largely a byproduct of semiconductors, one of your lead bulls being down almost 2% on the day. The big highlight of the day, though, was rotation from semiconductors into some of the more value-oriented sectors. And we've been talking about this for a while. Whenever semiconductors have a period of weakness, which is completely normal, they've really blasted off since the lows of April, you need to have the rest of the market there to kind of pick up the slack. And today, the market definitely did pick up the slack. Now, in terms of what exactly happened for semiconductors, it was a bit of mixed news, of course, in relation to earnings. NXPI, one semiconductor manufacturer, coming in with earnings this morning, and the numbers were a little bit disappointing. Sales falling by about 6.4%. The guidance for next quarter's revenue was optimistic, and it was 2.2% above the analyst expectations. And we also have signs of a cyclical recovery. The automotive inventory headwinds are easing. Now, we had noticed, as you guys might remember on the channel, that in the past 2, 3, 4 quarters, it's been a question of a lot of these companies in semiconductors, especially the ones exposed to automotive, the Internet of Things, consumer cyclical products such as phones and such as computers. They had been in a bit of a rut for the past roughly year and a half, and we've been trying to identify a cyclical bottom on companies such as Texas Instruments, on companies such as Micron, and other companies that have several segments that are exposed to consumer products, not so much the companies that are highly exposed to data center products. So as a result, this morning, NXPI led the sector for a bit of a downswing, but that also got magnified when we had some news from NVIDIA. So we obviously know that last week, NVIDIA got a bump because of the fact that most likely licenses were going to be approved for companies like NVIDIA, Broadcom, and AMD to start exporting some of their chips to China once again. US AI companies NVIDIA, AMD, and Broadcom are likely to receive licenses to ship to China at levels consistent with the prior threshold. We would keep near-term expectations in check, as outlined below, but it's a significant positive for 2026 for all AI stocks, including our top pick, NVIDIA, said one analyst from Morgan Stanley. That was good news, of course, but it was counterbalanced by the piece of news below. In other news, NVIDIA said today had told its Chinese customers that it has limited supplies of H20 chips days after the news that the ban on NVIDIA from sending its export control compliant chip known as the H20 to China was reversed. So as a result, we have a lifting on the export ban, but maybe these companies just don't have the products right now to actually fulfill those obligations to ship those products in a fast manner. As a result, the news kind of mixed today on semiconductors. That was what led you to the downside. And of course, semiconductors have been on such a tear that any little tidbit of negative news, of course, is going to pull the sector down from its ridiculous rally highs. So in today's markets, guys, we got a lot of things to talk about in the video. Number one, we're going to be going over 4 earnings that I have prepared for you guys. Number one is going to be, it's on this list right here, but we're going to cover MSCI, we're going to cover Lockheed Martin, we're going to cover Coca-Cola, and we're also going to cover Texas Instruments, which right now after earnings is down 10%. So I've taken those 4 companies because they have had some of the biggest moves on the day, but special shout out to Philip Morris International and DR Horton. DR Horton up 16%. We will probably do a DR Horton and a home builders analysis on the Friday session. There's just too much companies to cover in one single video, guys. So I'll cover 4 of them today. DR Horton and the rest of the home builders. We'll do that analysis on the Friday, but you guys know that I've been saying on the channel, guys, for now, like how many weeks in a row, the past roughly 4 or 5 weeks, that home builders was possibly a likely play as we see a, maybe bottoming out of the housing market and maybe a rekindling of the housing market deep into the bottom half of this year and into 2026. That is actually starting to materialize a little bit. So I'll do more of a large segment on home builders on the Friday section. For today, though, MSCI, Coca-Cola, Lockheed Martin, and Texas Instruments. After we're done those earnings, and trust me, I won't spend too long on each one of them. We're gonna blast through them just to say a little bit time conservative on the video here. We're gonna be going through our index rundown. All the major indexes, check on the rotation. After we're done that with some technical analysis, we will go through our big tech name list because a lot of big tech names were down on the day, but some were up. which ones are still good for swing trades, which ones are possibly still good for long-term positions. We will establish all of that in the second part of the video. And then at the very tail end of the video, guys, of course, I will take you through the market's biggest gainers and losers of the day overall. We'll go through some of the losers. Shout out as well to Equifax. They had earnings today too, down about 8%. Pretty decent buy in my opinion, but we'll take a look at that at the end of the video. And of course, the biggest gainers as well. Many of the home builders, the mortgage companies, even Restoration Hardware, the furniture companies, essentially the housing market trade with the interest rate decline. Very interesting thematic trade on the possible horizon. We'll take a look at that at the end of the video. So without further ado, guys, very long introduction, but it was kind of needed as earnings season right now is proving to be a little bit bumpy, right? A little bit bumpy. The companies are all reporting good numbers, but a lot of them are going down in a significant fashion. Not because the numbers are bad, but maybe because a lot of them have ran a lot in the most recent quarter, or maybe just expectations were just a little bit too high leading into this earnings season, right? So let's move into it right away. SPY up about 0.01%, roughly flat on the day. QQQ is down about 0.52% overall. You can take a look at the heat map. I mean, you can get a sense just from the equal weighted SPY right here. But just take a look here, guys. A lot of big tech names, very mixed on the day. Semiconductors, your worst performers. A lot of the popular names, cybersecurity, Oracle, Palantir down. However, here is the software play. We've been talking about this for a while, to where there was a lot of money going into the infrastructure side of AI, but not so much into the beneficiaries of all the infrastructure, which of course is software. Now we're starting to see a bit of an intra-sector rotation. So within technology, we are seeing some rotation. So pay attention to the software rotation right now. Financials, not a bad day, coming back. Healthcare, also a very decent day. So we really needed healthcare's performance to kind of counterbalance some of this weakness in tech. We got it today. And the bottom half of the market also not doing too poorly, other than some companies that had earnings, such as Philip Morris down 8, and some industrials, of course. Some of your defense contractors were also down as a result of Lockheed Martin's underwhelming performance, to say the least. So before we get into more of the recap, actually, you know what? One day relative performance, guys, most of all your major sectors were higher, only to the downside, communication services and tech. On the 1 week relative, very nice broad market push right now. Maybe not in your favorite names that have ran a ton, but as I've been saying for the past few weeks, whenever tech and semiconductors have a consolidation phase, you need the rest of the market to be there. You want to see the money rotating. If the money is leaving the markets, then we get the index consolidation phase, weekly drawdowns, right? Now, as a result, we are getting good broad market rotation. So the markets are healthy. Maybe not in your favorite names, but if you look at the market objectively, it is not doing too bad. So before we get into more technical analysis, guys, let us dive into these earnings, and we're going to try to do these as quickly as possible while still giving some pretty good information. So number one, we're going to take a look at Coca-Cola and what they had to say about the consumer. So Coca-Cola today down almost 1%, but they had pretty good numbers, beating on EPS by 4.37 and beating on revenue by 0.4. Now, the expectation for Coca-Cola coming into this quarter's earnings was a little bit low. They had obviously been guiding for macro uncertainty back in Q1 as a result of the tariffs. And for the last year and a half, Coca-Cola's guidance has not been that impressive because of the price pressures. Consumer discretionary, anything from drinks, food, eating out at restaurants, apparel, all that's been down. So we've been waiting for the cyclical bottom of these companies, even though you don't see it in Coca-Cola's share price, because the company's just very solid and an institutional favorite. We're waiting to see the numbers have an inflection point. And on some of these companies, I think it might just be here. Let's take a look at some of the numbers at a first glance on Coca-Cola. I will gladly move myself over for this one. So here we go. Revenue was up 2% year over year. Earnings was up 4% year over year, which is not too bad. The key takeaways here: North America revenue 3% higher year over year. EMEA revenue, Europe, Middle East, and Africa 5%. Organic revenue 5% as well. Nice boost on operating income and a reduction in operating expenses. So Coca-Cola is not a new player in this game. They've been through many economic cycles, and we saw this with Pepsi just last week as well, to where they've done a great job of cost cutting where they could, essentially, right? Repurposing their manufacturing and just having very good pricing and very good sales mix overall to kind of counterbalance the reduction in demand a lot of promotional sales and marketing as well. Net income was up 58% year over year, far better, of course, than last year when they were really struggling in the heat of the whole consumer discretionary downtrend. Operating cash flows was down a little bit here, but you can see the forward guidance was quite good. Organic revenue guidance 5 to 6% year over year, which is no change. They were coming into this year uncertain how it would actually unfold. Some of them were even saying that Coca-Cola may have no revenue growth for the entire year. That has since changed 5 to 6%, and a nice forward guidance on EPS by about 3% too, and a nice forward guidance on free cash flow, which was no change. Overall, guys, not too bad. Let's take a look at the article right now. Coca-Cola earnings beat estimates as strong demand in Europe helps offset the weakness elsewhere. Moving on forward, Coke reported second quarter net income to the tune of about $3.81 billion on Coca-Cola. That is roughly, let's call it 30.1% Q2 net margins, which is roughly in line with the company's standards, right? Over the past few years, high 20s, high 20s has been something that the company has been able to achieve. 30.1 is actually one of the better ones that they've had in the last 5-6 quarters. So nice to see them still driving those profits to the bottom line. Now, in terms of what they're talking about here for the product mix, I'll bring your attention to this right here, right? Revenues and volume. Take a look at this. Unit case volume was pretty much down all across the board, 1%. Europe was the highlight, 3% higher, but all the rest of the markets, Latin America, North America, APAC, and the bottling investments division of the company, they were all down. However, Coca-Cola still finding the way to have a bit of pricing power. Look at your price and mix category here for revenues, right? A lot of the favorable revenues have been driven by price and mix, not so much by unit case volume. So the company is managing the landscape very effectively, is the conclusion from that. Moving on further, net sales rose 1%. Company's organic revenue was up 5%. Coke's global unit case volume fell 1% in the quarter, which is what we just saw. Every division but Coke's Europe, Middle East, and Africa business reported shrinking volume, as we just saw. Coke executives has said that economic uncertainty and geopolitical tensions have weighed on consumer confidence, hurting its sales in some markets. However, Coke saw sales pick up in the second quarter in some of its challenged markets compared with the prior quarter. We're waiting for the inflection point, and this is commentary on the inflection point. Very important. Pepsi said the same thing. Several markets that were weaker in the first quarter improved volumes sequentially, including the US and Europe. In these markets, the plans we've implemented are working, providing further confidence we can influence the trajectory of our results. In North America, volume fell 1% as demand for the company's namesake soda declined. Still, volume improved compared with the first quarter. So it's all about the comparisons, guys. Are they better off than last quarter and even a few quarters ago? Well, yes, you can make that argument right now. Here's what the CEO had to say. I think that's in the context of a pretty resilient overall consumer. The aggregate spend is holding up. Yes, there's some pressure in those with lower incomes, where we're targeting some affordability and some special focus on marketing and occasions. For the full year, Coke narrowed its outlook for comparable earnings per share growth to 3%, the top end of the range it had previously provided. The company reiterated its forecast that organic revenue will increase 5 to 6% in 2025. So guys, right, if we're looking at the grand scheme of Coca-Cola earnings, of course we know that it's been a very tough landscape for the consumer, and the price action of Coca-Cola showed as much in the last 2 years of trading. We had a couple pops, had a couple drops, and now we're all the way up here, which begs the question, is Coca-Cola a buy if you enjoy this type of company? Well, let's have a look at the valuation real quick, yeah? At $69, where the stock stands right now, knowing that there's an inflection point in the business right now, cost controls have been good, end of year sales targets are possibly still going to be met. In that case, you're saying a 23.23 forward price to earnings, which is right around the company's historical averages. As a result, Coca-Cola is not cheap. It's also not that expensive either. Free cash flows have been very bumpy, but this is a company that stands the test of time. Very high net margins, usually, other than this year so far, a decent amount of free cash flow for the long term. And taking a look at EPS, they have no problem delivering on EPS for their shareholders and have no problem delivering on small but manageable revenue gains as well. So it's not the fastest growing company, but a lot of people have this one as a staple in their portfolio. It's not a company that I hold in my portfolio because the growth is a little bit slow. However, if you're looking for something that probably will never go away, that pays almost a 3% dividend, and a company that is currently at an inflection point, it's had a very rough last 2 years. But the future for Coca-Cola, the next maybe 2 years, is brighter than the past, and as a result, we may just be able to see some share appreciation. Don't expect this one to go to the absolute moon. The best you can expect is some very consistent gains and a very decent dividend yield. Hopefully that is insightful for Coca-Cola earnings. Now, stock number 2 we're going to be taking a look at here is Lockheed Martin, down 10.1%, one of their worst quarterly performances in recent memory. What exactly happened to LMT today? Well, let's have a look here. 10.54% miss on EPS and a 2.24% miss on revenue. Let's take a look at some of the numbers, guys, because we know the LMT, just for some context, right? Their sales pipeline is very bumpy. Okay, so they get a lot of very big contracts sometimes for their aircraft, of course, for their missile systems and all things of that nature. We know that earlier this year, President Trump allocated one of their big contracts for new fighter jets. He shifted them away from Lockheed Martin and gave it to Boeing. That was event number 1, but that's not the only things that are plaguing LMT's sales with a little bit of bumpiness, a little bit of cyclicality. And these defense corporations are known for their cyclicality. But because this one is down so much, I figured I should present it to you guys because it is clipping into some of the lows that we've had over the past 2-3 years, which raises the question, is it a decent buy? Let's look at the numbers and I'll give you guys my thoughts. So LMT earnings are right here. You can see them right there. Revenue miss and EPS miss by a wide margin. This is actually the GAAP EPS, because there's a lot of one-time charges and write-downs. We'll get into that in a little bit, but just so you guys can see, right? Aeronautics revenue, 2% year over year. Rotary and mission revenue, that was actually down 12% year over year. The missiles revenue, though, up a very healthy 11% year over year. But look at all these margin impacts. Net income down a lot. Operating cash flow down a lot. Expenses up and operating income down a lot. These are all due to some one-time charges, which we're going to get into very briefly. It's not a long-standing issue for the company, but definitely a quarter in which they chose to mark down all these items that have been affecting them over the past 3 months. Forward guidance, though, is not too bad. They are going to meet their end-of-year guidance for revenue. No change in that guidance. They are going to meet their, they're going to downgrade their EPS guidance because of these one-time items that they're marking down. No change in free cash flow, however, and they still are buying back a decent amount of shares, about $500 million worth overall. The backlog is slightly down due to them missing out on a few key contracts. But overall, the business, I would not say this is a structural problem for the business. It is a cyclical problem for the business. Let's move into it, shall we? Lockheed Martin tumbles on earnings. Here's why. LMT stock tumbled on Tuesday after the defense contractor recorded major pre-tax losses in its quarterly results. Lockheed said it recorded $1.6 billion in pre-tax losses on different programs, as well as $169 million in charges during the quarter, which impacted earnings by $5.83 per share, which was big. Let's go see what they're talking about. The company's aeronautics classified program has experienced design, integration, and test challenges, as well as other performance issues. The trend continued this year, which had a greater impact on schedule, talking about the lumpiness of their earnings, and costs than previously expected. As a result, LMT is now completing a review of its aeronautics program execution and management. Lockheed said it has made significant changes to its process and testing approach, resulting in significant changes to its schedule and cost estimates. Lockheed Martin recorded a $950 million in pre-tax forward loss on that program, talking about the classified program, more than likely military contracts, yeah? It also recognized a $570 million pre-tax loss on its Canadian maritime helicopter program, having to delay that, and $95 million on its Turkish utility helicopter program. So this classified program, a lot has to do with the F-35 deal, which went to Boeing, and maybe some other smaller deals here. And then we have one miss or one write down on the Canadian helicopter program and one from Turkey as well. Here's what the CEO had to say. CEO had to say that there were still positive developments. Several allied nations recently announced additional F-35 purchases. The U.S. Army has awarded more than $1 billion in missile-related contracts, and the U.S. Space Force is ordering additional satellites. Those were the highlights of this right there. But overall, guys, a very lumpy quarter for Lockheed Martin, talking about the stock. So hopefully that gives you an indication of why the stock was down 10.81 and why it probably does not impact the longer term fundamentals of the business. For this year, yes, but I'll keep in mind they're going to get an absolute ton of money over the next 2, 3, 4 years from the big, beautiful bill. And I assume as well, with a lot of geopolitical tensions right now, the orders, both domestically and internationally, will resume maybe by the second half of this year, but especially into 2026. So I do believe right now, Lockheed Martin, if this is the type of company that you want, it is possibly an interesting look for a buy. Keep in mind, this company right there usually has profit margins of about 10%, so not the highest profit margins. And we do have a decent forecast here. EPS will be revised to the downside, not revenue though, but EPS will be increasing in the next 3 years after that. Revenue as well will be increasing in every single one of the next 4 years. So it's not that bad of a look. Company right now is down 15% year to date, so it is lagging behind the index overall. It's a very large component in a lot of indexes and currently trading in around levels that you have not seen since October of 2023 and October of 2022 as well. We are getting a multi-year discount on Lockheed Martin. If this is a style of company that you want, maybe not a bad pick right now. At 412, the forward price to earnings is 18.31. Yes, I did use the revised EPS number to the downside. That gives them a PEG ratio of just under 2. That's not the best metric because Lockheed Martin doesn't have the most phenomenal EPS growth. We'll use price to sales just because it's going to be lumpy this year. Forward price to sales is 1.3. That is actually very low, in around the company's historical lows for that valuation metric. And the company's free cash flow yield is also pretty good, guys. Very, very, very good free cash flow yield. Not looking too bad for Lockheed Martin. Unfortunate miss because of those markdown in items. But these types of drops can represent buying opportunities here. We can notice if we use some long-standing moving averages, this is the 50 monthly moving average. This red line right there. It has not lost it since one time in 2011, and then you have to go back all the way to the great financial crisis. I think the company is trading a nice discount. It's trading in several conditions, short-term, that are oversold, big daily oversold conditions, and couple that with the fact that we're coming into very nice support, 413 out of 386. I would not mind accumulating a position on Lockheed Martin right there if I were looking to play some of these defense corporations. Hopefully that earnings review makes sense of what exactly happened to Lockheed Martin today. So as you can see, guys, right, Coca-Cola was not too bad. Lockheed Martin down 10.81%. Now let's go look at another very solid company that sadly just got hit a lot today. MSCI. I don't remember the last time that I've seen MSCI down after earnings. You'd probably go back to last year that I've seen them down 9%, and it was for the exact same reason. The company, are they doing fine? They are absolutely doing fine, guys. But this quarter specifically for earnings, I'm noticing a common trend. Are you guys noticing a common trend since we started earnings last week with the banks, with American Express, with Netflix? Wall Street is being very, very, very picky this quarter, extremely picky. If everything is not pristine and perfect, you are not getting much of a bump in price at all. That being said, did MSCI do well? They did extremely well. Very consistent business right here. 0.56% beat on EPS and a 0.3% beat on revenues too. So what exactly happened to MSCI? Why were they down a lot today? Well, let's have a look, shall we? So in terms of MSCI, let's just look at the numbers for what they are, and you guys tell me if you see a problem in this stock, yeah? Second quarter operating revenues up 9%. Margin gains right here up 1% to 55% operating margins. Very solid free cash flow gains, and also 131 million shares repurchased. This company is no stranger to buybacks. They do buybacks all the time, which does boost shareholder returns. Moving back into the earnings right here, operating income growth 11.1%. Very solid, right? So revenue's growing, margins are growing, they're still buying back stock. EPS 15% higher than at the same time last year. So what is going on? I don't know. Let's have a look deeper, shall we? America's revenue 7% higher, organic 7%, Europe 11%, Asia Pacific 9%. Not too bad. But here is the slight little mishap on MSCI. I'll remind you what MSCI does. If you guys don't know, they do the all world index ETF. So whenever you're looking at a Brazil ETF, a China ETF, a whole bunch of international ETFs, they have the largest suite of ETFs on the planet. So they have the indices business, kind of like S&P Global does or BlackRock does, right? They have the ETF suite of products. MSCI has ETFs as well. They also have a data analytics business, and both of those businesses are working very well with a very high retention rate. Moving on further, recurring net new subscription sales by region. America down 15%. Europe, Middle East, and Asia, they were down 36%, or in Africa, down 36%, and Asia Pacific, the only big gainer here at about 4% year over year. So Wall Street had a problem with this right here. Okay, the numbers are still positive. They're not losing any money, but just not as good as last year. So tough comps for the company. Take a look at your operating highlights right here in terms of organic revenue for the MSCI business overall, 11%. Index part of the business, 12%. No problem there. Analytics side of the business, 8%. Sustainability and climate reportable segment, they sell data for that as well, 11%. And all other and private assets up 8%. Is any line of business going down? Absolutely not. Okay, so let's move down a little bit further to see what exactly happened here, guys. Is the company struggling? No, I'm just going to bring you down to something else, which I've noticed as well, which is going to be all the way down here in your key operating metrics, right? As well, one thing that Wall Street maybe did not like to see is this right here, year over year recurring subscription run rate growth. The growth has been slowing over the past 3 quarters. They had very explosive growth, 21, 22, 23, now back down to single digits for growth in subscriptions. Quarterly retention rate trends, though, remain very high in around 94 to 95%. This quarter was 94.4. However, a downtick from 95.3, a very small downtick. So this, in terms of the subscription rate run rate for growth, that was down on a year-over-year comp. So that is what we saw earlier in the first slide when I was talking to you guys about this right here, yeah? So that was down, but also the number 2 thing that was down, sorry if I'm going through it too fast here, is the retention rate was down a little bit, just a little bit. But that's enough, right? Indexes, not too bad. Run rate growth, still very solid. Analytics business, run rate growth, also in line with previous standards. Sustainability and climate, that was down, and all other and private assets, of course, that was a little bit down too. But overall, right, the subscription run rate growth, that is what we're kind of looking at here for the growth metrics, not the revenue, because that comes as a byproduct of price increases. We're talking about the amount of clients, right? So that is the one pain point for the company right now. But overall, guys, I mean, I could take you through every single one of these slides, and you would be hard pressed to find much wrong with this earnings whatsoever. So I'll spare you the details. Just understand that MSCI is an extremely, extremely solid company. Look at the index revenue and the EBITDA, right? Look at this. This is a nice trend from the past 5 years. Do we see any problem with the company growing revenue from quarter to quarter? Absolutely not, right? Absolutely not. Whether it's earnings or whether it's top line revenue, the company is doing phenomenally. Take a look at their other metrics right here in terms of net margins. This company always prints high 30s net margins. This quarter right here was 39% and 55% operating margins. Very, very good for the business. Are they making a lot of free cash flow? Company is indeed making a decent amount of free cash flow per year, and free cash flow increases every year. They also do not have any problems with debt overall for the business. Taking a look at their growth, is the growth consistent and predictable? EPS growth, very consistent, very predictable. Revenue growth, very consistent and very predictable too. However, they had these small little mishaps, right? In terms of a slight reduction in the retention rate of their clients and very tough year-over-year comparables for subscription rate growth metrics. Those 2 things alone, those small little things, contributed to a 9% decline in MSCI. When I'm telling you guys that Wall Street's being very picky this quarter, I mean it. They're being extremely picky. That being said, this company does trade somewhat rich, kind of like its sector peers do. BlackRock, SPGI, they trade a bit rich. Why? Because their earnings are so consistent, right? Now, that being said, at 525, is it a good deal? They're trading at about a 31 forward price to earnings, a 2.57 PEG, a 13.17 forward price to sales, and a 3.3% free cash flow yield. You might assume that these numbers are high, and they are, but MSCI has always traded rich. It's the same thing with SPGI. Whenever we cover this company, I say it always trades rich. Moody's Corporation always trades rich as well. Why? Well, for the simple fact that their earnings are just so consistent. Think of companies like Costco, think of companies like Big Tech as well. When you have a very consistent all-weather business model that makes it through recessions and makes it through bull markets just fine, Wall Street tends to give them a higher valuation. But whenever the numbers are not pristine perfect, you can see these outsized moves. In my opinion, MSCI is not a bad pick. If you're looking for something, a company of this nature, I prefer S&P Global, myself personally. That's the one I have in my long-term portfolio, only because they have the ratings business as well. SPGI has the rating business, but they also have the index business, and the data analytics. This company only has indexes and data analytics. They're missing that ratings component, which makes S&P Global a more well-rounded company, but there is nothing wrong with this business at all, guys. I mean, nothing wrong with it all. Consistent EPS, consistent free cash flow, and coming shortly into the 200 weekly EMA. Every time this company has tested this 200 weekly EMA, I mean, we can go back all the way down to here, 2012, right? It's usually always been a decent buying opportunity for the stock. The stock has done largely nothing for the past 4 years in terms of stock price. But what has it done in the past 4 years? Well, I'm glad you asked. They've increased EPS by a very substantial margin. They used to run about $10 in EPS, 17 now. Not quite a double, but it's getting there. Revenue, have they increased from 2021? $2 billion, this year, $3 billion. That's 50%. They've improved all their metrics and margins, but the stock price is still roughly around the same price as it was before. That is when you can possibly say that this one is indeed a deal, and I do not mind taking a bit of a swing trade position on MSCI if they come down a little bit lower. Call it 510 to the lower bound of support down there, you know, in the high 400 range. 510 out of 400 for me would indeed be a buy. That's everything I had for you guys for this company. And now for company number 4, another company that reported very decent numbers. This company right here, Texas Instruments, is down, I'll move myself over, 11.5% in the after hours. Did they deserve it? Arguably not. Wall Street is being very picky this season. EPS beat by about 4% and revenue beat by almost 2%. So what exactly happened? Well, it had to do with quote unquote disappointing guidance. But when I show you guys what was disappointing with the guidance, you will also think that this drop might just be a little bit overdone. But keep in mind, the company from last quarter is up 55%. So it was up to them to prove it to us, right? Can they sustain that gain, or can we maybe be due for a pullback? Well, it was the latter. Their earnings were great. The guidance was not bad at all, but unfortunately, not good enough maybe to justify a 55% rally in just 3 short months. Let's get into it. So if you don't know what Texas Instruments does in the grand scheme of the semiconductor landscape, well, they have over 80,000 different parts. Anything from amplifiers, audio, clocks and timing, data converters, sensors, RF and microwave, power management, motor drivers, a whole bunch of components that you probably never think of. They're not a very flashy company, they're not a very sexy company, but they're an integral component of the entire semiconductor landscape. They make everything from calculators all the way to missile defense chips, right? Chips that go into missiles or chips that go into fighter jets as well. So they're a very broad company, an integral component of the semiconductor index overall, and a very large weight, a weight that some of you may not think they have, but they are a decent sized weight in the context of the semiconductor landscape. The company is currently worth about $195 billion, yeah? So let's take a look at what was so bad about TXN's earnings. Well, let's have a look at some of the numbers right here. Revenue beat by 16%, or it was up 16% year over year. Adjusted EPS, 16% year over year. Net income, 15% boost year over year, and operating income, 25% year over year. So they beat on EPS and revenue for the quarter. Tremendous gains on a year over year comparison. So what exactly happened? Let's have a look, shall we? For the current quarter, Texas Instruments forecast earnings of $1.48 per share. The expectation, $1.51. Huge miss, right? Very fractional miss right there. Sales of $4.63 billion. That was the forecast. Wall Street had 4.59. So they actually beat on the sales estimate, but because they missed EPS by 3 pennies, the company is now down 11% for no good reason. Very, very picky market right now, all things considered, right? Taking a look at some of their segment breakdowns, we can see here that in terms of revenue by product category, all of their categories did very well. Take a look at their analog revenue, which is the bulk of the revenue right there, 38.25% total change, which is very, very solid. Very, very solid numbers overall, right? From 3.2 to 3.5 billion. That is absolutely fantastic. All right. In terms of the embedded processing revenue, we're looking at a total change right there of 7.27. That's not too bad, right? From 600 million to 700 million. Not too bad for the embedded segment. And other segment revenue, 0.3 versus last quarter, which was 0.2. So Texas Instruments, you remember earlier on in the video, I was talking to you about the cyclical nature of some of these semiconductor stocks and how we've been trying to ascertain the bottom of them. Well, TXN was no different, right? You can clearly see a cyclical drop when a lot of their components, either that were exposed to the consumer, right? PC parts, personal electronic components, automotive, Internet of Things, and other industrial applications, they were all down. This company dealt with high levels of inventory in 2022 and 2023. That inventory buildup led to a decline in sales for that period, and we've been trying to ascertain when is the turnaround period for that. You can see it with the drop-off in EPS. You can see it with the drop-off in revenue. When is the turnaround period? Well, the turnaround period is supposed to be somewhere around now. And judging from TXN's revenues and EPS guidance, that is indeed the case. They are rounding the corner to better and better numbers for the next 2 to 3 years. So moving further, we can also see that their profits have also been increasing as a result of the, cyclical rounding of the bottom right there. And here's some of the results from their earnings slides. We can see here that, yes, we've already covered the gains in revenue from all the different divisions, but also their operating profits, guys, 27% better than at the same time last year. Operating profit for the embedded processing division, that was up 6%. And from the other segment, that is also up 26%. So we can clearly see an inflection point right here. The numbers are moving in the right direction. However, not enough to uphold the stock price. So rather than spending too much time on this earnings call right now, everything was overall good, guys. There's really nothing majorly wrong with this report. The company is doing well. We have now identified a possible cyclical trough in the business, and it will be doing well moving into the future. We can get a sense of that from their EPS. We can get a sense of that from their revenue. We can also get a sense of that from their increases in profits as opposed to this very same time last year. So keep all of that in mind for TXN. Very solid company, right? If we take a look down here at the balance sheet, you will see that, yes, they have incurred a decent amount of debt as they've ramped their operations for the next leg of growth. That is completely normal. A lot of companies have invested in heavy amounts of capital expenditures over the past 2 years to sustain the next leg of growth for these companies. Companies such as Micron have done that, NVIDIA, AMD, Intel, TSM. A lot of semiconductor players have spent a lot of money recently to sustain the levels of growth that they will need to have in terms of product output for the next 3-4 years. Free cash flow is a little bit soft. Cash on the balance sheet is also a little bit soft as they've used most of that for their recent investments in infrastructure. But overall, guys, the company is not doing too bad. This quarter, we have just reported very beautiful net margins too. Their net margins for a semiconductor company are very good. Talking about high 20s to low 30s. This quarter came in at 29.2% net margins. Very, very solid. There is a return to growth in the second half of 2025, and that should still persist into 2026 as well. Personal electronics is still somewhat weak, but we know that it's rounding the corner. So is this company right now a buy at $190 per share? Let's have a look, shall we? So the forward price to earnings is a 34. The forward PEG ratio right now is 1.72. That's just the PE divided by their very good EPS growth rate over the next 4 years. And the free cash yield is a little bit low. So is TXN my first bet for semiconductors? Probably not. It's a solid company. If I was holding any shares, this earnings report would not make me nervous. But is it the best buy in the entire industry right now, just per the valuation? I would have to say no. AMD has a much better valuation for this for more growth. Micron has a much better valuation than this for the same or better amounts of growth. Take a look at Micron. We did their earnings not too long ago, right? Forward price to earnings, low. Forward PEG ratio, very low. AMD, same concept, guys, right? The forward PEG ratio, very low at 1.33 and higher EPS growth. So TXN is not my first bet. Now, would I mind taking a bit of a swing trade from possibly support level right here, which is around 190, which is where they are right now, to possible recaptures of all-time highs, maybe later on in the year? I wouldn't mind taking the swing trade, but as I said, it's not my favorite company. It's a very good company. It's an integral component of the entire semiconductor landscape, but just not my favorite play for the valuation and for the growth at hand. So this company's earnings will likely affect semiconductors tomorrow. And when we get these results from either NXPI, right, which we had earlier this morning, they're down from their earnings call right now, 5%. And TXN, right, they're also down 11.5% right now. The way that I like to play this is if that weakness pours into the companies that I actually want to play, such as Micron or AMD or NVIDIA on pullbacks, well, I will play those companies instead. Okay, so hopefully that makes sense. Wrapping up today's earnings journey, guys. I think we're getting a sense of how Wall Street is going to act with companies over the course of this season. So if I had one piece of caution to give everybody is be very careful of companies such as Microsoft that ran any company that has ran a ton in the last 3 months, guys. They're on the chopping block. They will have to show perfect and pristine current quarter numbers and future guidance to justify these ridiculous rallies to the upside, yeah? Because we've seen in today's earnings, but not only today, last week as well, a lot of companies that had very good numbers, there was one little thing that just didn't rub Wall Street the right way, and as a result, their stocks go down 5, 6, 7, 8, 10, 11% like TXN, right? So pay attention to this, guys. Maybe buying these companies into earnings, talking about Microsoft, talking about Robinhood, talking about Palantir, maybe all these companies that have had very strong rallies from the bottom of the tariff segment, well, maybe it would be more prudent to wait until after earnings to possibly position. So that's what I'm going to say on that matter. Conversely, other companies that have been lagging behind, right, such as the home builders, yeah, DHI was an example of that today. Other companies that have been lagging behind, maybe such as Apple, maybe companies such as Google, which report earnings tomorrow. Maybe companies such as Amazon, which, you know, Amazon hasn't been lagging, but, well, I mean, you can argue that it is or it isn't, but it's not blasted past the all-time high, right? It's at a very good rally from the bottom, 34%, but not egregiously overbought, right? And not arguably overvalued either. So maybe the companies that we would want to take a lottery gamble on for a bullish leaning earnings position would be the companies that have been trailing, not the ones that have been the biggest winners. And I'll remind you, another company like that was Netflix. They had fantastic earnings. They went down. Micron had fantastic earnings. They've went down since earnings. You can find many of these examples in the past 2 weeks of time. So that is my piece on earnings. I know it was a long segment, but it's earnings season, right? So these videos will run a little bit longer. Hopefully, I'll be able to give you guys some insights, some trade ideas, and everything in between. That being said, let's dive into our indexes right now, shall we? So the SPY, roughly flat on the day, but we'll go through these quickly because nothing has changed, right? Daily uptrend is nice. Looking for a daily higher low. Anything above this guy right here, 518, looking for a daily higher low. And we're just looking for further trend continuation. Pay attention to the 12 EMA. If you do not lose the 12 EMA while also setting a daily downtrend, then weekly consolidation is simply not underway just yet. Wait until the bulls roll over, and then we can say, okay, weekly consolidation is likely, and maybe we just go back down and test support, which is 610 down to 600. The higher low on the weekly is 591, so the bulls are working with a lot of space. But as of right now, the bulls are in full control of this daily time frame and of the weekly time frame too. So wait for the break. Don't predict the markets, guys. Wait for the confirmation. Moving on to the Qs right now. Qs, a bit of a down day today, but who's in control? Still the daily bulls, looking for a new higher low. Anything above 550, this yellow line, looking for a new higher low for possible further trend continuation. In the event you see them lose the 12 EMA on the daily and set up some price discovery to the downside, right? A daily downtrend pattern, then you know, okay, maybe we're in for a week or two of slide and repositioning, which could bring us into our previous support of 536 down to 521, and the 12 EMA on the weekly is there as well. That would be a likely backtest scenario. On to healthcare right now. So healthcare, financials, excuse me, have been the beneficiary of a bit of bullish rotation. So if the rotation to the downside continues, if we keep seeing tech and semiconductors, two of the biggest winning sectors over the past 3 months, if they go into a bit of consolidation mode, well, you want to see the rest of the market there to pick up the slack. So far, it has been working. One of them has been financials. Daily downtrend into a nice engulfing move. The bulls are looking to reset the daily uptrend. So right now, anything above 51.31 on a downswing, looking for a higher low for possible further trend continuation. Also keep in mind, we got a lot of support right there, and the bulls are in control. 52 down to 50.35 is your support range. Beautiful leg of expansion, looking for the higher lows and maybe looking for a bit more. If tech continues to be weak, I would expect financials to continue to get some bids. onto healthcare right now. Healthcare up 1.86%. No change though. Really choppy range over the course of the last 3 months of trading. So we are still looking for the bulls to put in an expansion leg. You would need a break of 137 to the upside. Close above on the weekly, give us the weekly uptrend. That would consolidate these to be your monthly lows, and you might just be looking for a bit of an upswing. We've been talking about this for a while, guys. XLV has been lagging behind SPY by a very wide margin. Usually the divergence does not last this long. They usually move in tandem together. Whenever you see a long-standing divergence, 3 to 4 months, usually that does not last forever. So I'm still looking for a bit of a healthcare bid for the sector overall, and I'm using the sector ETF to make that play. I have leap call options on XLV for 2027, usually into support and a long-standing EMA such as the 50 monthly. You know, when you start to see confluence like that, maybe not a bad time to position. Moving on to SMH. SMH down 1.77, flushing the daily higher low, 284, right? No new highs and now low. If they proceed weakness, furthering of the weakness into tomorrow, this is a new daily downtrend, the first one of its kind since all the way down here. We have not had a daily downtrend, not since the rally. This has been a consecutive series of uptrends, higher low, right? Equal high, higher low, push, no daily downtrend there, none here. Watch out. If this is one, then you are possibly embarking on a little bit of weekly consolidation, healthy weekly consolidation after how many green weeks in a row? It just takes a few of these earnings calls to really send the index into overall consolidation. In my opinion, will be a buying opportunity. First touch down here, 275, and the second larger touch would be down here around 260. So please keep that in mind. The weekly bulls are working with a ton of space right now. Any dips will be for buying, and I will be using my favorite type of trade to get those buys off, selling puts below the market on very big volatile days when some of these semiconductors can go down 3, 4, 5, 6% in a single day. Moving on to the Russell right now. The Russell getting a bit of rotation up, 0.83% to the upside. The daily time frame right now is very choppy. It's a battle. The cleaner time frame, in my opinion, if you want to focus on one time frame, should be the weekly. The weekly is not looking too bad. We're hovering, though, midway between resistance, which is 232 down to 225, and support down here, 217 down to 208. Any revisit of support below, I would maybe be a fan of possibly positioning for some swing trade longs into resistance. We will see if they actually give us the pullback or if they just choose to go a little bit higher and crack through resistance. The Russell should be a beneficiary, if ever, because most people associate the Russell with only tech, but it's actually not, guys. If you look at the IWM sector weightings right here, you'll notice that, you know, a lot of this sector weighting right here is, oh, it's not going to give it to me. Wait, give me a second here. Oh, there you go. Okay, so that's the S&P 500. That's not going to do some work there. I wish you could give me the breakdown. Give me a second. All right, so I found one for you guys. Had to pause the video, my bad. So here it is. Financials, almost 20% of the Russell. Industrials, 18. Healthcare, 15. And information technology is only 13. As a result, if information technology, aka tech, goes down, but all the other major components of the market get a bit of a rotation, well, the Russell will move up as a byproduct. So keep that in mind when you're doing your analysis of the Russell. Moving on to the VIX right now, the VIX actually down 0.9%. Nothing to see here, guys. Just understand, right? We're still pending the next volatility catalyst for some increases on the VIX. We are not getting it. Nobody knows if it's going to be from tariffs, from geopolitical conflicts, or anything in between. One thing's for sure, if the VIX has a rapid rally, your indexes most likely at the same time will be embarking into consolidation. I will be a seller of options down here, but the time that it's down here now, I'm looking to buy companies in terms of leap call options that have been left behind a little bit. You should be a buyer of options down here, but not on companies that are pushing all-time highs consistently, right? With high implied volatility. No, low implied volatility companies that have been left behind a little bit. And here's when you'd want to be a net seller of options. I don't mean selling your calls that you bought back here. No, I mean like selling covered calls on stuff, or maybe selling put options in the open market. Moving on to the dollar, nothing much to see here as well. A little bit weak today. We're still looking for that new weekly uptrend on the dollar to find the bottoming process. As right now, the weekly bears control this entire time frame. And until the time that changes, well, we're not going to find a local bottom for a monthly time frame. This, however, is good. It's going to give some currency tailwinds to a lot of companies like Visa, MasterCard, and some big tech names in this earnings cycle. Moving on to the yields right now. Yields dropping a little bit more over the course of the day today. Nice 5-day drop on the yields. But let's be honest, right? Are they really moving anywhere? No, we're still dangerously close to 4.5 on the 10 and still somewhat dangerously close to 5% on the 20-year yields. until I see a breakdown on the 20 of beyond 4.75, I cannot say weekly downtrend is underway. And the same thing for the 10. Until we get a clear breakdown below 4.2, I cannot say clear weekly downtrend is underway. And as a result, I cannot say that a nice new uptrend is started on the bonds. It's a good area to accumulate, but this trade is very bumpy. So you got to have a lot of time in terms of the thesis on that trade. Take a look at gold right now. Gold down, gold was up another day. It keeps changing at 6 p.m., so my bad for that. Gold was up 1.02%. So this was a very nice trade, guys, right? The back test down here of support, which was roughly 3,300. Very nice entry opportunity, but now the trade is coming in to take profit. If you're buying gold longs here, you are indeed late, but you could obviously make some money. I don't like buying things late. I like buying them down here. Matter of fact, in the Discord group, we did take a few swing trade longs on gold, but nothing that we were holding for the long term, just playing level to level trading essentially. But if you're playing the larger levels, well, your next take profit area is, of course, the all-time high breakout, 3,500. The weekly uptrend was never lost. Higher lows have been established, decent area to position, and now looking for a bit of expansion. Gold is not actually looking too bad. In terms of Bitcoin, Bitcoin is actually up 2% today. Right now, it's been consolidating sideways. No new lows on Bitcoin. 116 will be the mark. This looks like a bull flag, right? So you're going to keep an eye on the bull's capacity to maintain this weekly rally right now. In the event you lose 116, that will be a daily downtrend. That will be synonymous with weekly consolidation. And where could you be heading? Maybe to prior resistance, 112 down to 109. The 12 EMA on the weekly is there as well. Weekly bulls in full control would just be looking for a new higher low for further trend continuation. This is where I would be buying some Bitcoin swing trade longs, as now the longs that we have should be coming in to take profit. Like, right, I have split swing trade longs on Bitcoin, right, on chain, from some of these support lows, right? From the prior established bull flag that was forming in this area, and now my take profit is 125 psychological. So if you're starting a swing trade here on Bitcoin, it's very late, but you know, you can make an argument that if you want to start a swing trade here, the stop loss would be below 116, because if you lose 116, you invalidate the trade thesis. If you want to start a trade here, guys, the stop loss is about $3,000, $4,000. Your upside target is not much better at 125. So it's about an equidistant risk reward. Not my favorite trade, but if you're a long-term investor in Bitcoin, I think there is still a lot more upside to be had in this asset. Now, that's everything for your overall market rundown. Let's move into big tech. We're going to try to do these a little bit quickly because I don't want to make this video exorbitantly long. So moving into Apple, you can clearly see something that's going on here, right? Apple and Google, some of the names that were left behind from the rally. Now, when the rest of the market is red in terms of big tech, a lot of these other names have ran a ton. These are actually participating. So Apple not looking too bad. We've been commenting on this for a while, right? This was a bull flag. You're starting to get some expansion into resistance. Resistance 221 down to 213. First daily close above the 200-day EMA since March 10th, to be specific. So that is obviously noteworthy to us. Daily uptrend is in motion. If we get a pullback here looking for a higher low, anything above right here, 207 looking for a higher low. Possibly if the bulls run out of steam, right, get rejected, we might have to do it in a few legs, similar to what Amazon did prior, right? They kind of struggled to get through this resistance range, kind of grinded their way through it. Maybe that's what we're going to see with Apple. The clearest time frame, in my opinion, is the weekly, though. Beautiful weekly uptrend. Higher lows are set right down here at about 206, looking for a bit of a leg of expansion. So curious to see what Apple has in store for us for earnings, but I've been a big fan. I actually have a leap call contract that we started last week on Apple, going for this expansion, going for a bit of a swing trade, bit of a catch-up trade on Apple, as right now, year to date, it is still down roughly 14.4%. Onto AMD right now, down about 1.45, as well as the rest of the semiconductor index, but trying to fill the gap right here, 147. Still no true gap fill overall, but we can clearly see a bit of a daily downswing. That being said, we're coming into support right now. 154 to about 145 is your cleanest area of support. If the rest of semis fall off tomorrow and AMD gives back too much of the move, comes below support, and then, you know, we get a bit of a downtrend. I just want to put that into context for the next few weeks, right? What are we looking for in most semiconductor names? Just some healthy weekly consolidation. AMD just did that a few weeks ago, right? It's a very beautiful weekly uptrend. There's no red flags right here, but we are maybe looking for a bit of weekly consolidation, anything above 133, looking for a weekly higher low. If AMD really comes down hard, I'll be looking to sell some put options down here to collect some very juicy premium. And overall, the valuation for AMD still remains somewhat attractive if you're looking to build a position for the next 2-3 years for their data center ramp. Onto Amazon right now. Amazon down about 0.8%, but still clipping into the top end of resistance. I sadly cannot close this box into a green box, even though we clipped above it briefly. I can't close it green until the weekly candle closes, right? So that being said, who's in control right now? It is the bulls. Anything above 222, looking for a daily higher low for possible further trend continuation. Keep an eye on the 12 EMA. They've largely maintained this 12 EMA for the past 3 months. Amazon is not looking too bad. In the event you lose it and set up the daily downtrend, right, into earnings, I mean, there's not too many days. Next Thursday, to be specific, we are just looking for weekly higher lows. Anything above 207, looking for a weekly higher low on Amazon for possible further trend continuation. We will see what they have in store for us for earnings. I'm very bullish for this company. It's my largest position overall. I think the next 2-3 years will be great. It's just tough to predict where the short-term price action will take them before earnings, because earnings will probably move them about 6-7%. Moving on to Google right now, up another 0.5%. Same concept for Google. We are peaking above the resistance range, which was 190 down about 183. I will not close this box green until we clear it on the weekly, until we close this weekly candle. However, tough to say what's going to happen to Google. Why? Well, because they have earnings tomorrow. So in terms of the expected move for Google tomorrow, after the close, we're going to be looking at an expected move of 5%. So 5% higher could take you right into the prior all-time highs, right? Around 200, just above 200. And 5% lower could take you right back down here below, well, now it's kind of still resistance until the candle closes, 181. So the way that I'll be playing this, well, I'm already positioned. You guys know I have some leap call contracts from back here. The way I'll play this, if they have an earnings decline, I will gladly sell some put options below. I think they'll have very good numbers in terms of cloud, in terms of search, in terms of advertising. They were very good last quarter, and I do believe they'll be good this quarter as well. But for ever which reason, Wall Street just doesn't like the numbers. As we've seen with many companies this quarter, guys, it's been a tough ask to get some green after earnings, that's for sure. If we do get a drop, just remember who's in control. Still the weekly bulls. You're looking for a new higher low, anything above 163, looking for a weekly higher low. So believe me when I say any earnings weakness, we'll cover it tomorrow, and I'll give you guys more thoughts. I'll be looking to play the downside. If we get an earnings pop, I already have all the shares. I bought all the shares that I needed all the way back there. Moving on to Meta. Meta down about 1.14%. Now looking too bad, coming back into support. 702 down to about 678. Still the confines of a daily downtrend. If we get a lower low, still a daily downtrend. Pay attention to this guy right here, 678. If you lose 678, guys, sadly, you would lose the weekly higher lows. And that would be a big thing. If you lose the weekly higher lows, it's been 3.5 weeks of consolidation. If you lose those, you're going to a bit of monthly consolidation. However, Meta has earnings next week. So they could cut this, and then if earnings are fantastic, well, then we'll have a bit of a rally, right? So I would rather wait to position on Meta until after earnings. Same concept though. If Meta drops after earnings for XYZ reason, maybe because they ran too much in the last 3 months, I will be a buyer of Meta, especially if we can make our way back into the mid 600s. The valuation in around 700 is not that bad, so I will be a net buyer of Meta shares down here if we start tagging into the mid 6s. Moving on to Microsoft. Microsoft down 0.94%. Overall, not too bad of a day on Microsoft, but still, keep in mind, watch for the loss of this 12 EMA, especially into earnings. Especially in earnings. You saw what happened to Netflix, right? Drop on Netflix, daily downtrend. They lost it prior to earnings. Earnings were good, and still they dropped. Pay attention. You might be able to see something like that on Microsoft coming soon. Challenging the 12 EMA. The bulls are still in control. Anything above 497, looking for a higher low for possible further trend continuation. But if you forfeit the 12 and go down with the daily downtrend, that is the start of weekly consolidation. And believe me when I say they need it. Weekly overbought conditions. Where can we maybe pull back to after earnings? Well, maybe back here, 477 down to about 467, this previous pocket. I will maybe play Microsoft on a pullback, but the one thing I will not do is buy it up here. I did a good job of buying all my Microsoft shares I needed there and there, not buying it, not especially at this valuation, which is at the top end of the range. Moving on to Netflix, we were just talking about it, down another 3.5%. Why? Not because earnings aren't good, no. Just a bit of profit taking and an unwind, right? How much was this stock up from the bottom? Stock was up 60+%. Now we are getting a very natural unwind, challenging the bottom end of support, 1185. Pay special attention. If you lose 1185, you lose the weekly higher lows, you effectively lose the weekly uptrend. It doesn't mean you go into a weekly downtrend like this, an extended one. They can just do one weekly leg of consolidation, and then the bulls can get it back. But if they lose this, the uptrend is lost, which means it's in a phase of monthly consolidation. And whenever I see that, I just look to where the 12 EMA could be on the monthly likely area. If we come back down to $1,100 or, in the tens, $1,000 range, I would pick up a little bit more Netflix shares, but I was very, very consistent in my messaging that I'm not buying up here, I'm not buying here, I'm not even buying for support. But if they do come back and pick me up for some monthly consolidation with such strong numbers, I will gladly buy the fundamentals. What I will not do is buy an overbought price, especially on a monthly RSI that looks like that. Moving on to NVIDIA right now, same concept, right? NVIDIA down 2.54%. The bulls still control the daily uptrend, looking for a higher low on any downswing, looking for a higher low. Anything above 151, looking for a higher low for possible further trend continuation. Now, in the event you lose the 12 EMA, which is the short-term momentum guide, if you lose the 12 EMA, come back too much from this move and establish the daily downtrend into the next few days, well, that is the start of weekly consolidation, similar to a lot of other semiconductor names, right? NVIDIA has had a phenomenal rally since the bottom, but you can't get too greedy on these trades. The stock is up 96%, almost 100. If I take the actual lows, it is up 100%, right? 2x in a single quarter. So every good thing comes to an end. Maybe we start to see some pullbacks. I will be a fan of buying those pullbacks in the 150 range. If you get a sharp pullback, I will definitely be selling some put options down there, as the valuation will be a bit more manageable than it is right now. Right now, it's not too bad, but still, if they can give me a bit of a discount here and I can sell some options 150, I'll take that bet. On to Tesla right now. So Tesla also has earnings tomorrow. Difficult to derive any short-term price action. The expected move on Tesla is going to be roughly 6%, which is somewhat low for Tesla. Usually this says like 8, 9, 10%. 6%, where does it put us, right? Top to bottom. Well, to the upside, right back into resistance, 360 to 340. And to the downside, 6% puts us back down into support, 300 down to 258. I will be waiting for earnings and the call and the guidance to establish whether or not I want to position for in Tesla, for a swing trade. I'm not going to touch it right now. Things to look out for on earnings. Of course, earnings per share, free cash flow, and net margins. We know that we're losing the consumer incentives of $7,500 for a new car. We are also losing the manufacturer incentives, which are Tesla regulatory credits that it gets. Those two things will impact margins. However, of course, there's going to be a lot of focus on the robotaxi evolution. And one thing that Tesla does better than other robotaxi businesses, such as Waymo, is that they have a far better average cost per mile. So although they are not fully scaled up, that is the long-term Tesla thesis. If Tesla can, and also all Tesla cars can eventually become robotaxis, of course. They don't have to be specifically built for that. I know they're making the cyber cabs, but you can use your Tesla Model 3, the Model Y, could potentially be purposed for robotaxis on the road, which is the long-term thesis, right? With millions of vehicles in circulation and a very low cost per mile to run a robotaxi, it makes them the more efficient player, which is where the Tesla long-term thesis comes in. So we will see. Tomorrow, it will be a battle of two narratives. A battle of a struggling car business with very weak deliveries and dwindling margins, and the long-term positive thesis, which is the expansion of the robotaxi network, expansion of Optimus, expansion of the energy business, and things of that nature. So curious to see. I'll cover it on the channel for you guys. Moving on to Palantir right now. Palantir down 1.8%. So Palantir as well, having a bit of a slide. However, just looking for a daily higher low. Anything above 128, looking for a daily higher low for possible further trend continuation. So we'll see what happens if Palantir pulls back too much. You open up the door for the daily downtrend, and you open the door for very healthy weekly consolidation. Anything above 129, looking for a higher low for possible further trend continuation. But I would be, and I'm telling you guys this as a Palantir shareholder, right? If these earnings are not the best earnings that the company has ever posted, right? Alex Karp is going to bull post the heck out of them. But if Wall Street is not convinced that this revenue expansion rate and the EPS expansion rate is sustainable, well, what do you think is going to happen to the stock, right? If companies like MSCI, Equifax, and others are going down off of tiny little bits of underwhelming news, what do you think is going to happen to Palantir if they report anything other than the craziest earnings anyone's ever seen when they're trading at this high valuations, right? That's why you need to be a bit cautious about Palantir right now. So I'm not going to be positioning on Palantir into their earnings. I would rather just sit on the sidelines. I'm probably going to sell some covered calls into earnings, wishing everybody the best of luck. But as of me right now, this is a no touch per my strategy rules. Moving on to SOFI right now, down about 0.85%. It was down over 3.5% early this morning, and same concept, right? Had a very large rally and now pulling back. Rejection from resistance above, which was roughly the whole 22.5 to 24.5 prior all-time highs from 2021. That being said, we're still in a very nice weekly uptrend. The higher lows on the weekly are all the way down here at 1282. Any pullback, so if you lose the daily, guys, it doesn't really matter, right? If you lose the daily, even though we got a lot of space, if you lose it, daily downtrend, just looking for very healthy weekly consolidation. I've been very firm in saying I'll be looking at 18 to 17 range to play a pullback. They have earnings next Tuesday, so not too many days of price action remaining for SOFI. I'd be highly surprised if they pushed above this zone before earnings, but I will also be highly surprised if they come down into earnings. So I think they might just stay muted prior to earnings, which of course, again, is next Tuesday. We'll cover that on the channel as well. But all these companies that have earnings very soon, right? If we're not positioned from prior, I'm not going to start gambling on earnings positioning here. Moving on to Uber right now. Uber up 0.69%. Beautiful number. Looking very decent here at support. 92 down to about 90. We have not flushed this very big bear engulfing move, right? Daily uptrend, 100% engulfing move. It opens up the door for the lower high into the lower low flush. We'll see if we get that. If we do get that, we are still just looking for a weekly higher low, weekly bulls in control. Weekly uptrend is very nice. Looking for a weekly higher low, anything above 82. Looking for the higher low, rather than trying to predict whether or not we react from support and go back to the all-time highs. I would rather just wait. And if I'm patient enough and we get more declines here into earnings season, I'll be looking to sell some put options down here in the lower 80s, where the valuation is a bit more manageable than it is right now. Everything being said, guys, I have all the Uber shares that I needed. I was very vocal on buying Uber down here, especially during the tariff sell-off and the later stage of last year. I am full on Uber shares. It's not a terrible ad right here, but the risk reward is just not as juicy as it once was. On to TSM now, lastly. TSM down 1.78%. They have now officially given back the entire earnings push. And it's not that earnings were not good. Earnings were fantastic, but just continuous overbought conditions, a very sizable rally from the bottom, talking about what, right? 85%. Eventually, you are going to be due for a pullback. That being said, daily bulls are in control. Anything above 226, looking for a higher low. Couple gaps remain to be filled. This one right here to be filled at about 228. We'll see, right? Can they hold up the 12 EMA? Can they hold up the uptrend? Or do they lose the 12, set the daily downtrend, and head into weekly consolidation? If it's the latter, I will be looking to play that pullback. And where am I going to be looking to play? Under 220. If I can find some puts down here to sell to the market, selling short puts essentially for a bit of a pullback phase, I'll be looking to do that. Why? The fundamentals are very strong, and this will just be a very natural and healthy technical pullback. That is everything I had for you guys for the overall market rundown. Hopefully you enjoyed. And in order to keep this video under an hour and 10 minutes, I'm going to go through this biggest gainers and losers list very fast, guys, and let you know some of the areas that I want to buy. A lot of these were earnings plays. We're not going to talk about them. We already did talk about them. Circle, looking to play the volatility. Another big red day. We can sell some puts under the market, preferably around the 150, 160 region. Play the volatility. Look for 0.5% per week. That is the same thing that I do on CoreWeave, but Circle should be a very nice long-term performer. As a result, short-term volatility, in my opinion, great opportunity to sell some puts or maybe just accumulate some shares progressively right here, 190 down to 175. Equifax, we did not cover their earnings. I'll try to do them on Friday. Very solid company coming into the 200 weekly EMA. This is the very nice support region. I am a buyer here of Equifax, 240 down to 220. No matter how you want to play it, either with short puts or accumulating some shares, I think the company will do very well in the next few years. Looking great for some expansion here of multiple lines of business. Look at the EPS ramp. Bit of a cyclical company in terms of what they've tried to redo in the past few years. We'll talk about it more on Friday, but Equifax for me is indeed a buy based off those criteria alone, and we're coming into support. I know I'm going through these quickly, guys, but I kind of told you I would, right? Moving on to AppLovin. AppLovin still struggling to break out here. Still very nice support, 345 down to 310. Decent area for some swing trade longs. We're still looking for the expansion of the weekly time frame. Fundamentals are not too bad. Take a screenshot at 350. The forward price to earnings, the forward peg ratio rather, is quite manageable, right? The stop loss for that trade would be down below here, 308. And if we're looking for expansion targets, first one will be 430, and then the all-time highs. Spotify, this one has been coming down, but it just gives you an idea of, how much it's ran since last quarter, yeah? So Spotify will become a buy for me again. If we can pull back down 640 to 612, we'd just be looking for a little bit of weekly pullback, a little bit of monthly consolidation, which is natural for every stock. This one looks exactly like Netflix. So be a little bit careful. Don't be too greedy, right? On Spotify, the forward peg ratio in around 640 is decent. And that is also where I would not mind starting a new position on Spotify. If you take a look at a few more, Shopify, Shopify, not too bad, but the trade is kind of one and done right now. I was telling you guys that it was a great buy here for a breakout, another great opportunity here for the breakout retest and run, and now we are just running. So any pullbacks on Shopify, you might see me sell some put options down below here where we just lifted off from, right, in the teens, 110, 112, 113, etc. They have earnings coming up on the 6th of August, so a bit of time still. I think this one is positioned very nicely for some expansion in the next few years. Take a look at your EPS growth rate right there. Very solid EPS growth rate and very solid revenue growth rate as well. Shopify could be surprising. So even for some shares, guys, for the next, 6, 12, 18 months, not a bad proposition to be buying some of these pullbacks on Shopify. And of course, the last one that'll do is Micron. Micron is coming into my buy area. Big fan of selling some short puts. It was on the top 5 options list this week. So keep that in mind for this location on Micron in terms of selling some puts, or maybe starting some further swing trade longs. Valuation is very good. This is a multi-year expansion trade as well. In terms of the upside, guys, the home builders, rather than me giving them to you individually, you might just consider the ETF. ITB, very attractive leap call opportunity. 2027 leaps, you can go slightly in the money. The leverage is fairly good. You are looking for a cyclical reversal of these companies into the next 2 years. So although you're not buying the lows, you're still buying some of the cyclical lows. It might be a bit of a bumpy trade, but it is indeed one that I like overall. Rather than going through each one individually, we'll do them on Friday. But just as of right now, that's a thesis. Restoration Hardware could be a bit of a lottery trade. The company's financials are not too bad down here at the $200 range. It would not be crazy to see Restoration Hardware trade back into the mid 350s to 400s at some point in the next 6 to 9 months. This is part of the housing trade. Anything associated with homes and financing are catching a bid. Restoration Hardware might just be one that you could consider, not for a very large position, but for a thematic swing trade to the upside. So those are the ones that I'll be eyeing. You guys know me. I've been in Rocket Mortgage. I closed one of my calls. We bought calls back here, guys. Those calls are now up 100%. I closed half the trade, made it free, and I'm riding the rest into 20 bucks. I wouldn't say necessarily for shares that you're late in this trade. It's looking fairly good. This is another thematic trade for your housing market expansion. And the bottom half of the market, I'll try to cover a bit more of it tomorrow. But a lot of these other plays, guys, we're performing, like, look at Starbucks today, 4% to the upside. Very nice coming out of support. I'm not buying any Starbucks, but I'm not going to lie. It's not looking bad, guys. For a stop loss down below here, and then just riding shares for the expansion thesis of the business, not a bad position, not a bad swing trade, in my humble opinion. Elf Beauty, you guys know how I've been trading this one. Any rapid declines in price, I'm selling puts down here in the lower 100 region. I'm holding all the shares that I bought down here, looking for a bit of a weekly uptrend resurgence. And we can talk about many other names in consumer discretionary, but we'll try to cover a bit more of them as we move into the rest of the week, guys. I got to cut this video loose right now. I apologize. It's an hour and 12 minutes. It's earnings. So sadly, through earnings season, when we have a lot of earnings to cover, guys, I'll cover earnings because I can do deep dives on them. Sadly, the biggest gainers and losers list will kind of take a back seat through earnings season. I'll try to do the best that I can, but you guys know I try to make these videos as quickly as humanly possible while giving you guys the most amount of information. So hopefully you guys enjoyed. That's everything I had for you guys today. If you enjoyed, consider dropping a like, consider subscribing to the channel as well. We appreciate both of those things for the growth of the channel. And also, if you have any questions, feel free to leave them down below. That's it for me. I'm out of here. Have a great evening, and I'll see you guys tomorrow after the close for some very juicy earnings recaps. Tomorrow we'll be covering Fiserv, Chipotle, Google, and Tesla. So take care, guys. Don't get too greedy in this earnings season. Just remember what I said, right? Just be careful, be wary of those companies that have ran a lot into earnings. You may end up disappointed. So take care, guys. That's it for me. See you tomorrow. Peace.